So my star of the week is Netflix, NFLX on the Nasdaq. So the stock is up about 5% in the past month and 43% over the past 6 months, where it's currently trading at a price of about $675 per share, which is essentially back at its all-time high reached in late 2021. It has about a $290 billion market cap. Now, obviously, Netflix doesn't really need an introduction, but if anyone doesn't know, it offers entertainment services such as TV series, documentaries, films, and games across various genres and languages. Now, let's take a look at what is driving the increase. So first and foremost, the company's strong financial results are driving the share price higher. So first here, average paying members in the quarter were up 14% year over year to about 265 million. Total revenue grew about 14.8% year over year. GAAP EPS or earnings per share was $5.40, an increase of 84% compared to Q1 of 2023. And I will note that Netflix does have net debt of just under $7 billion, but this debt is certainly sustainable considering the company produced free cash flow of about $6.91 billion in the last 12 months. Now, number two for what's driving the share price gains is that management increased the company's fiscal year 2024 operating margin guidance from about 24% to 25% and now expects revenue growth to be about 13 to 15%. Now, a concern many analysts have voiced in the past with Netflix is that it wasn't going to be able to continue its strong track record of financial growth. But management indicated that on top of providing quality, engaging entertainment, looking forward to 2025, the company is looking to scale ads to be a more meaningful contributor to the business. So it is going to be interesting just to see how that trends with the financials. And lastly here, number four, what's been driving the share price, Netflix has been doing a great job at engaging subscribers with the roast of Tom Brady reaching the largest ever weekly viewing total for a one-off special. And on top of this, Netflix is looking to host the Mike Tyson versus Jake Paul boxing fight, which is now expected to take place in November of 2024. So I think they are in a great position to benefit from more one-off live specials, especially potentially dabbling into more sporting events such as, boxing. So all in all, I think getting back to its all-time highs is justified given the strong fundamentals, healthy growth in users, and optimistic outlook for the business. Now trading at about 46 times trailing EPS. I mean, that's still, maybe on the pricier side. However, but to put this into perspective, this is much lower than the 80 times trailing earnings that it was trading at in 2021 when it last reached its all-time high. So as such, Netflix has taken our coveted spot of star of the week, and it's going to be interesting to see how their fundamentals or financials continue to trend here over the coming year and into 2025, especially when they start, trying to propel their ad revenue, and we will see how they roll that out.
Yeah, I mean, I think it's done well to rebound. I think it's a little bit pricey based on revenue growth is slowing.
Yeah.
So, I mean, we have to factor that in. It's 35 plus times, this coming year's earnings. That's a high rate for revenue growth that is slowing. And compared to some of the other large, it's in the tech sector or the, it is not net cash. I mean, it's no problem servicing its debt, but it is as opposed to like the Microsofts or the Alphabets of the world, the huge net cash positions there. I mean, different companies, obviously, but you're paying a significant premium once again, and the growth rate is slowing. Certainly a better company than it was the last time it hit, that high, but you're paying the price for it right now.
Yeah, exactly.
I would say that like where we saw in the 2010s to 2020 or so, we saw that disruptor stage, that ultra growth stage, and that's why it was getting that 50 to 100 times valuation, because that was expected to continue. And then finally, once it drops, you see that 70% drop in price within the few months once it gets revaluation into a more mature company. Because during that decade, we saw they were able to access third-party media, but now you have competition. Disney had pulled their back library from Netflix. You saw Paramount come on the stage and all the Hulu in the US, even though they were around, Netflix started to rely more and more on their original productions, and now we're seeing them go on to those one-offs like Brennan was saying, and I think that is what they're looking towards, is because then they do get like the kind of pay-per-view, what used to be pay-per-view audience, into Netflix subscriptions, and instead of just relying on a backlog of library like they were a decade ago, because wasn't until I think 2013 that House of Cards, that was their initial production, which might have been earlier than that, when they started to do their initial productions that weren't relying on third parties. And we saw during that decade, that's when they really grew. And now you're seeing another stage in the business cycle, really, of maturity, to where they are needing to branch out into pay-per-view. And they've been looking to look into video games as well, but I don't think that's been going as well.
Yeah.
And so you're really seeing a shift in company maturity, I would say.
Yeah, it is interesting too to look at Netflix this week, because there are streaming merger talks that have kind of been in the rumor this week. Paramount Global is in talks to merge its Paramount Plus streaming service with another platform. That deal could spark new streaming partnerships potentially. Warner Brothers Discovery is interested in combining Max and Paramount Plus, aiming to better compete with Netflix and Disney platforms. Earlier this year, Warner Brothers Discovery discussed a full merger with Paramount Global, but those talks stalled. So a merger could offload Paramount Plus's losses by sharing ownership. Warner Brothers Discovery's streaming platform made about $103 million in 2023, while Paramount Global had a loss of $1.67 billion. So there's, we're talking about Netflix right now. There's, a lot of activity going on in that streaming sector right now. So we'll continue to monitor that.
Yeah. And I guess the last thing that I just want to say on it too is, getting back to early or late 2022, early 2023, the stock was trading with a trailing PE of, closer to 28 times. So, you can definitely see that investors were, maybe bidding the stock back up, trying to, get more of an attractive price in, a good business. But like Ryan said, growth is slowing. So that is certainly something to keep an eye on.